Welcome to another episode of Market Brief After Hours. We've got a packed show for you today, dissecting a very dynamic session on the global stage. Despite lingering geopolitical tensions, equity markets showed some serious resilience today. We saw a major comeback in tech, specifically chip stocks, while oil prices pulled back. Let's start with the big picture in the U.S. What were the headline numbers from Wall Street?
It was a solid recovery day. The tech-heavy Nasdaq composite led the charge, climbing 1.30% to close at 26,207. The S&P 500 wasn't far behind, gaining 0.81% to finish at 7,544. Meanwhile, the Dow Jones Industrial Average added about 139 points, which is a 0.27% gain, closing at 52,487.
That's a pretty decisive move upward, especially considering the backdrop. What was driving that optimism?
It was really a story of semiconductors doing the heavy lifting. The VanEck Semiconductor ETF jumped 2.5%, with Micron technology leading the way, up 4.5%, and SanDisk popping 7.6%. This chip rally gave investors a reason to look past the geopolitical headlines, at least for the day.
And those headlines were pretty intense. We had reports of the U.S. launching fresh strikes on Iran for the second day in a row, following attacks on commercial shipping in the Strait of Hormuz. Usually, that's a recipe for surging oil prices, but crude actually fell today. How do you explain that?
It's a bit of a relief valve situation. Even though the U.S. Central Command confirmed those strikes, crude futures fell about 2% today. Brent crude closed down 2.2% at $76.30 per barrel, and West Texas Intermediate lost about 2% to settle at $72.08. The reason for the drop is that mediators from Qatar and Pakistan are actively trying to bring Washington and Tehran back to the negotiating table. Also, President Trump mentioned that Iran had called to make a deal, which calmed some immediate fears of an all-out escalation, even though he had previously suggested the ceasefire was over.
So, a bit of a diplomatic lifeline keeping oil in check. But some market strategists are warning that this conflict is still highly inflationary and uncertain.
Absolutely. The ongoing friction in the Middle East is spilling into a broader inflation problem. It's not just about oil. When you combine geopolitical disruptions with strong economic growth and a consumer that just keeps spending, you get a very persistent inflationary environment. In fact, some analysts believe the market isn't fully pricing in the possibility of at least one more Federal Reserve interest rate hike in the second half of 2026.
That's a crucial point. Speaking of the U.S. economy, we also got some fresh data today on jobs and housing. What did those numbers tell us?
We saw weekly initial jobless claims fall by 2,000 to 215,000 for the week ending July 4th. That's a 6-week low and came in below expectations. On the housing front, though, existing home sales threw us a curveball. They unexpectedly dropped by 2.4% in June to a seasonally adjusted annualized rate of 4.9 million. Buyers are just incredibly sensitive to mortgage rates and affordability right now.
It's a delicate balance. Let's shift our focus across the Atlantic to Europe. European markets seemed to mirror that resilient tone, didn't they?
They did. The pan-European Stoxx 600 index closed up 0.78%. Germany's DAX and France's CAC 40 both posted strong gains, rising 0.89% and 0.90% respectively. Switzerland's SMI also managed a 0.29% gain.
The UK's FTSE 100 was the outlier, though, ending slightly down by 0.16%. What held the UK back?
AstraZeneca was a major drag there, shedding more than 6% after announcing that its nerve disease drug, Wainua, failed to meet its target in a late-stage trial. However, the UK market did get a boost from its mining sector. Companies like Anglo American, Glencore, and Antofagasta saw gains between 4% and 6%, which kept the FTSE from falling further.
And we had some interesting economic data out of Germany, Ireland, and Greece, too.
Yes, Germany's trade data was a mixed bag. Imports fell 2.5% in May to a 3-month low of 118.8 billion euros. But exports unexpectedly rose by 0.9% to a 3.5-year high of 137.9 billion euros, largely driven by a massive 23.1% surge in shipments to the U.S. Meanwhile, inflation is showing signs of cooling in other parts of Europe. Ireland's consumer price inflation moderated to 3.4% in June, its lowest level in 4 months, and Greece saw its inflation ease to 4.4% in May, down from 5.2% the previous month.
We're going to take a very quick break, but when we return, we'll dive into the Asian markets, check in on some key Forex levels, and run through today's big corporate movers. Stay with us. Welcome back to Market Brief After Hours. Let's head over to Asia now, where tech also seemed to dominate the narrative. How did those markets fare?
Japan's Nikkei 225 had a strong showing, rising 1.38%, while the broader Topix gained 0.35%. Much like the US, Japanese tech stocks led the way. Kyosha Holdings jumped over 8.3% after Bain Capital sold its entire stake, and chip-related names like Advantest and Tokyo Electron both climbed over 5%.
And what about China? We saw some contrasting moves between the mainland and Hong Kong.
Exactly. Mainland China's CSI 300 surged 2.5%, the Shanghai Composite rose 1.65%, and the Shenzhen component jumped over 3%. We saw massive gains in tech there too, with companies like Xi'an Bright Laser Technology jumping 20%. This happened despite economic data showing that China's consumer prices rose slower than expected in June, at 1%, while producer prices accelerated to 4.1%. On the other hand, Hong Kong's Hang Seng Index fell 0.7%, dragged down by consumer and auto stocks like Geely Automobile, which declined 4.5%.
And elsewhere in the region?
South Korea's Kospi rose 1.1%, again supported by tech plays like Hanmi Semiconductor, which advanced over 8%. Down under, Australia's S&P ASX 200 slipped 0.26% to close at 87.62. But across the Tasman Sea, New Zealand's S&P NZX 50 rose 0.88%, boosted by a really strong manufacturing index reading of 54.7, marking its fifth consecutive month of expansion.
Now, let's look at the currency markets. We've seen some highly technical trading lately, especially with major pairs interacting with their moving averages. Let's start with the euro.
The Euro-USD pair closed slightly up at 1.1427, representing a minor gain of 0.09%. But the big story here is that the euro is consolidating well below its key moving averages. The 50-day simple moving average is at 1.1566, the 100-day is at 1.1607, and the 200-day is at 1.1648. This tells us that the medium-term bearish trend is still very much in control, even if we are seeing a brief pause near the recent bottom of 1.1416.
The British pound, however, seems to be fighting a much tighter battle.
Yes, GBP USD closed up 0.13% at 1.3406. It's currently sitting right in the middle of a major cluster of moving averages. It is fractionally above its 50-day average of 1.3397, its 200-day average of 1.3399, and its 100-day average of 1.3404. It's a massive technical battleground. A decisive daily close above 1.3431 could open the door for a recovery toward 1.3500, but a rejection here could send it back down.
And what about the dollar-yen? That pair has been on an absolute tear lately.
It really has. USD JPY paused slightly today, closing down 0.11% at 162.41. But the uptrend is incredibly dominant. The pair is trading way above its moving averages. The 50-day is at 159.89, the 100-day is at 159.21, and the 200-day is all the way down at 156.98. All of these averages are sloping upward, confirming that the bulls are still firmly in charge.
Let's also touch on the Australian dollar before we move to commodities.
AUD-USD edged higher, closing up 0.14% at 0.6939. It's in a bit of a tug-of-war. It's trading below its 50-day average of 0.7075 and its 100-day average of 0.7066. But it's holding above its critical long-term 200-day average of 0.6872. As long as it holds above that 200-day line, the long-term structure remains intact. Let's pivot to precious metals. Gold and silver both had major sessions today, staging some pretty aggressive bounces. They certainly did. Gold surged 1.05% to close at $4,122. Now, structurally, it's still in a long-term downtrend, trading well below its 50-day average of $4,379, its 100-day of $4,622, and its 200-day of $4,469. But today's session high of $4,138 showed a very strong rejection of those lower prices. Silver was even more dramatic, jumping 2.80% to close at $59.88.
Like gold, it's deeply disconnected from its key moving averages, with the 50-day at $70.48 and the 200-day at $69.31. But this massive bounce off the $57.60 low suggests we might be seeing some short covering or bottom fishing. Very interesting technical setups across the board. To wrap things up, let's look at some individual corporate movers that caught your eye today.
Let's start with Cerebras Systems. They closed up more than 9% after announcing plans to expand their European AI infrastructure. What's interesting is that this jump came despite Goldman Sachs downgrading the stock to a sell with a price target of $19. We also saw trucking companies get a big lift after Citigroup upgraded the sector. FedEx Freight rose over 7%, while Old Dominion Freight Line and ArcBest both closed up more than 3%.
And on the losing side,
Granite Construction was a big decliner, plunging more than 12% after Goldman Sachs downgraded them to a sell with a $13.39 price target. Paramount Skydance also dropped over 4% following a downgrade from Arete Research. And finally, PepsiCo closed down more than 3% after reporting a second-quarter operating profit of $4.02 billion, which missed the Wall Street consensus of $4.06 billion.
a lot of moving parts today, from geopolitics to individual earnings misses. That's all for today's edition of the show. If you find this useful, please follow Market Brief After Hours on your favorite podcast platform. We'll see you tomorrow.